Kevin, will the so-called K-shaped economy extend into 2026? And if so, how divergent will each side of the K become?
So I think it depends on which part of the K. There's sort of mini Ks all over the economy. If you think about maybe one that does converge a little bit, this large cap versus small cap gap that has really opened up over the past year, mostly driven by tariffs. We could see that actually easing a little bit. You could see that in some of the earnings data. It looks actually more beneficial for some of the smaller parts of the market. Not to say that Russell 2000 outperforms S&P 500 definitively, but that's an instance where you could see some convergence. I think the divergence probably still persists in the labor market, especially when you look at youth unemployment really having accelerated a lot. A lot of sort of the haves in the labor market, high earners still doing relatively well. To me, that split probably persists heading into 2026.
Is the economy to a certain extent detached from the stock market? Because the stock market has kept hitting new highs throughout 2025, and we kept hearing warnings about problems with the economy.
Detached, no, because I think, well, in one instance, if you're looking actually at direct exposure that consumers and just overall citizens in the U.S. have to the stock market, you're actually at all-time highs in terms of household exposure to financial assets. So in that sense, not necessarily detached. But when you talk about this really significant plummeting in sentiment that we've seen, both in investor terms, but mainly in consumer terms. Surveys from University of Michigan, surveys from the Conference Board, there's been a significant deterioration over the past several years. It's really, why we've sort of behind the coining of our term of this vibepression, where it's been this depression in consumer sentiment, yet asset markets have done well. GDP has continued to go higher. Payroll growth, yes, has slowed, but the stock of labor is still right near an all-time high. So it feels disconnected in those terms when you bring it back down to corporate profits having been relatively resilient. That's really the case why equities have been bolstered so far.
Well, speaking of disconnected, where are valuations heading into 2026, and do they matter?
So, what's interesting about this year, for the first time in a long time, earnings growth has actually driven the market much more significantly than multiple expansion. And that really changed, post-April when you started to get into the summer. That forward earnings component really started to pick up in terms of being a more significant driver for the market. So something we think persists probably into the first half of 26, but that probably gives you a little bit more runway actually for multiple expansion to do some heavy lifting maybe into the back half of next year. So it's actually become less of a multiples story and more of an earnings story, which we think all else equal is a solid backdrop, especially because very different from 2025. You're actually expected to see earnings growth for all 11 sectors in the S&P in 2026. So that broader base of earnings growth is a support.
Will consumer demand weigh on earnings growth? If people are worried about losing their jobs, they're not going to spend as much. And this is a consumer-based economy. How will that filter through to earnings in 2026?
Yeah, so I think for labor, that's where this stock versus flow dynamic and theme, which is central to our macro outlook for next year, is really going to come into play because the overall stock of labor is still relatively high. We're right near an all-time high, especially after the jobs reports we just got for October, November. The flow has slowed considerably. So you're down to 22,000 payrolls over the past 3 months on average. But if that stock of labor stays relatively high, where you don't see a significant spike in layoffs, and you continue to see sort of this gradual move higher in the unemployment rate, that keeps that spending engine month to month relatively stable. So it doesn't mean that you have stellar consumer spending, which is why we're a little bit more optimistic on the business investment side than consumer spending for next year. But that engine of spending can continue month to month as long as you don't see this massive pickup in layoffs like you tend to see in a traditional recession.
Okay, you've been referring to the stock of labor. Let's talk about stocks themselves. Which sectors do you like in 2026? Where should people put their money?
Yeah, so right now we're pretty optimistic on communication services, healthcare. We've taken sort of more of a neutral approach on something like tech, which tends to be, the big focus for investors, just because of its sheer size in the market and how much it's grown over time, but also because its centrality to the AI theme. So it's not that we're pessimistic on it, but when you look at the earnings profile for revisions, but also what's expected to come for 2026. The fact that estimates have become a lot more optimistic and they broadened out to the rest of the market in all 11 sectors, as I mentioned, that's a little bit of a better story for the rest of the market, not as much for something like tech, which has been, in the first place, taken first place on the podium for the majority of this year when you look at it on a month-to-month basis. Not to say that that can't continue just because of momentum slowing in and of itself. But when you think about the earnings backdrop having improved, the effective tariff rate probably reaching a peak sometime soon, companies being able to digest that a little bit better, sets the stage for probably a better backdrop for the so-called average stock in 2026.
And then finally, will international stocks outperform domestic stocks? Because it was a great year and an unexpectedly great year for foreign stocks in 2025.
Yeah, so that sharp degree of outperformance, I'm not so sure that that continues. I mean, our thinking behind it from, an investor's portfolio, the perspective of an investor's portfolio, when you back this up 10 to 15 years, I mean, the exposure to the rest of the world outside the US has been sort of chipped away at over time just because of the dominance of the US. So this year was sort of a corrective year in that sense, but we think that that kind of performance can continue, not necessarily sharp outperformance, but that kind of performance can continue when you think about central bank easing around the world now starting to probably have lagged effects, beneficial effects for the rest of the global economy, but also, manufacturing PMI starting to turn up a little bit. And again, the earnings profile looking just a lot better than it had been. Plus, you add in the fact that the dollar is probably not poised to see any significant gain next year. As long as you sort of see maybe a sideways move and you don't see any material pickup, that probably accrues to the benefit of ex-US markets.
All right. Well, thanks for coming on and talking about it.
Thanks so much. Appreciate it.